Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good, Derek. How are you?
Not bad, not bad. I think the listeners are probably wondering what happened to our beloved Timberwolves.
Oh,
R.I.P. All right. Great run.
Nice while it lasted.
Anthony Edwards, just what a great series, and the beloved Nas Reed, he did great too. So
yeah,
just a great run. It was fun to rally around them.
Yeah.
Well, guys, as you know, and as our listeners are becoming more aware, on this show, we talk about the infinite banking concept and how we can utilize our own personal banking strategies to secure our legacy and build generational wealth. But we also like to talk about our faith and family and stewardship. So in this particular episode, we're going to be talking about Nelson Nash's grocery store example in his book, Becoming Your Own Banker, which, of course, we've been on a long trek already. So this is on page 15 and 16 of Nelson's book. And just to provide a quick overview as to what this section is about, it is titled The Grocery Store. So you may hear us talk about a grocery store example, but really what Nelson's doing is he's using this as an analogy or a metaphor to talk about your own personal banking system. And so along the way, we're going to decipher these points, these touch points of this analogy, and try to make it a little easier for our listeners to understand how this relates to the infinite banking concept in your own family banking system. So guys, first thing I want to draw everyone's attention to is Nelson says that this is an exercise in imagination. And in the last episode, we just talked about imagination here. And so he's going to use this example of groceries because everyone needs groceries in their life. Mm-hmm. Everyone is a consumer of a grocery store, but not everyone is an owner or the seller of these groceries. But here he says you need to think of an example of this business where you are both the consumer and the seller. And so that's why he hones in on this grocery store example. In the first paragraph there, he talks about captive customers. Would one of you guys like to explain what's it mean to be a captive customer?
I'll take it. I think, he's talking specifically that you and your family need this thing. And obviously in this scenario, he's talking about the grocery store, that you not only benefit from getting the groceries, just like you could from any other grocery store, but now you benefit as the owner of the business. So I think you're captive to it, not in a bad way, but you are now very interested. You have an investment in this business as both the customer and the owner.
And so in terms of the infinite banking concept or the family banking strategies that we talk about, we're utilizing a whole life insurance contract to facilitate our need for finance. And so your family is a great example of that captive customer. Your family members are going to need finance as well, just as much as you do individually, with them purchasing vehicles or needing appliances or a down payment on a house. They're a captive customer because you already know them, and you know bits and pieces of their finances and how much they need finance. And so this is a great way to utilize them as somebody that is going to be captive for the rest of your life. All right, guys, so let's just think about starting a business from scratch, right? And in this case, we're talking about a grocery business. No matter what business you start, there's always going to be a phase where you need to have a lot of capital in the beginning years before that business starts to become profitable. The same way is true with an infinite banking policy or your family banking system. When you're capitalizing the system, there's going to be a period of years where you are paying premium to the life insurance company before this system really starts getting supercharged. And what we mean by that is where your cash value is greater than the premium outlay that you have paid into the policy up until that point. And that's going to be different for each person, going to be different based on how we design policies. But when we're thinking about the business here of the grocery store, Nelson's going to talk about location. He's going to talk about merchandise. He's going to talk about advertising, payroll, all these things that are unique or not so unique really to businesses, but it is also applicable to our family banking business. So guys, talk to me a little bit. What are some of these factors in the startup phase of an infinite banking policy that could also correlate to this example of the grocery store?
Yeah, I love this this next part of the the grocery store example, and I think it speaks to just Nelson's teachability, his skill as a teacher. He he really goes to great lengths to give you the description of starting a grocery store. He does that with other things, like later in the book he'll talk about starting a bank and goes into great detail. And I think he's just a really good teacher. He captures your imagination and helps you really understand in a different analogy what he's talking about in IBC. And so some of those factors, Derek, I think one of the most important ones, especially how he's talking about scouting out, location, 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 when finding the real estate, when thinking about the right things to put on the shelves, relating that to IBC, I think education is, for me, I think was the primary thing that I needed in order to start and in order to feel comfortable with starting my policies and with starting as big of policies that I did. I know some people maybe like to get their feet wet a little bit and start small policies, which, hey, if that's your path, then there's certainly nothing wrong with it. But I think throughout that process, education is huge to scout out, all the details that you need to know before starting. And that's where we come in. That's where helpful resources like our podcast, like other books, really sharpen people's understanding of IBC. And without that, I think the power of IBC gets lost.
No, I would totally agree with you, John. That's actually a really good analogy of the education piece, because like you said, Nelson goes into really good detail, like how he set up the business and all the components of it. And I never thought about it in that way, the education piece of it, because that's such a critical component of understanding this process. And, we're all really passionate about infinite banking and permanent whole life insurance. And so we're always listening to podcasts, reading articles, reading books, nonstop, basically. And that was like really key, because if you wouldn't have had that education at the beginning, wouldn't have even been able to get the personal bank going. So that's a real key component.
Yeah, I like to think about the startup costs in your life insurance policy is that period of time before that cash value is starting to approach the premium basis or exceed that. Mm-hmm. And so what's happening there? Well, for the insurance company, they have business costs. They have legitimate costs that need to get paid. And so your premium dollars in those early years are helping to cover some of those business costs, such as their payroll for the underwriters, the insurance agents, the professional staff, their legal team, their accounting team, so on and so forth. The premiums that you pay in those early years, a large portion of that is going to help offset some of their business costs as well. And so just like with the grocery store, where it's going to take a period of time before that business or any business becomes profitable, the same is going to be true in many ways with your infinite banking type policy, where you're going to see a slight drag in the early years, but we need to think past just year 2 or 3. You need to be thinking generationally here and realize that this is a great place to store and protect your wealth, to pass it along to the next generation. So guys, Nelson's going to move on. He's going to talk about not only the display of the goods and walking through the aisles of a grocery store, but he's going to talk about the hired help. John, can you help explain what he means by the hired help and how is that applicable to our conversation tonight?
Yeah, your hired help. That's what he's talking about later on. And they're the ones roaming the aisles. They're the ones making sure everything's stocked. They're the employees of the grocery store. That's how I see it. And I think that's a fair representation. And how that parallels, especially for me, thinking about my personal banking system and my personal family. I have 2 kids, my wife and 2 kids. We all have policies. And I think about the generations that my family bank will be used for, and the habits that are forming today. And if I am the hired help, or sorry, if I'm the owner of the grocery store and I'm the one stealing the peas, I'm going in the back door, I'm just taking anything that I need for whatever meal I'm making. Everyone else is watching. Everybody else is watching the leader. I think that goes with any team, any leadership structure. If the leader's doing it, it's more than likely those under the leader are going to follow. And this is no exception. And I think in my family bank, I don't think there's any exception there, that my kids, as they grow up and as they see the habits that I'm forming and establishing, to pay back my policy loans, more, greater than even retail rate, that we'll talk about probably later in this episode, is critical to maintaining a profitable family bank. And knowing that I'm going to establish that habit, my kids are going to not only see it, but learn it and establish it in their adult lives, and continue, so that it can bless all the generations down the road who get to benefit from this family bank.
Yeah, great. Yeah, so just to back up a little bit, provide a little more context here. So Nelson's going to be talking about, as John alluded to, someone walking out the back door of the grocery store. And in this example in the book, he's saying that the owner of the grocery store, let's say myself, my spouse, my wife, if she were to purchase groceries at the grocery store, is she going to walk out the front door and pay taxes and pay the retail prices? Or is she going to walk out the back door where we were procuring our food for the grocery store at a wholesale price? What is she going to do? And what we need to stop and think about is what's going to help the business in the long run. Human nature says, yeah, I want to go out the back door because it's cheaper. It's easier. I don't have to pay taxes. Whereas that's not going to help contribute to the profitability of the business. You're going to be out of business very quickly if you're not turning a profit and selling those cans of peas at a greater margin than what you had purchased them at. So when it comes to the infinite banking concept and family banking strategies, what John is saying hits the nail on the head here. We need to set a standard for our families as to how we treat these policies. We're not going to be stealing the peas. In other words, not paying back the policy loans. We're not going to be stealing the peas. In other words, not paying or only paying what the insurance company is charging. We're going to go above and beyond that, guys. We're going to charge ourselves at least retail on our policy loans. Talk to me a little bit. What does retail mean? Why is that so pivotal for this conversation?
I think one of the things that I think about, so wholesale, we talk about wholesale, like when you take a loan against your policy from the insurance company, the insurance company is charging you wholesale rates. They are not marking it up with prime. If you go to a bank, you're going to be getting their wholesale plus prime. And then you're going to be and that at the minimum, that's what Nelson's talking about, paying retail, paying your loans back at least at retail rates. But if you really want to accelerate and get your bank rolling, you manage your money, get that rolling, pay even above. And I would say that lots of times I think about that in a structured way. Like, is it you kind of like say you take a $10,000 loan out against your policy, do you amortize that and then you pay it back in schedules? You can. If that's how you like to do it, you can. I'm a little more, I like to pay mine back. I'm an honest banker in big chunks versus small chunks. That's kind of how I work. So if I know I'm going to be getting or potentially getting a bonus down, later in the year, I'll take a policy loan out to buy an asset or to cover an emergency expense or to take advantage of an opportunity. And that might cost me $10,000. I may not pay that back for a few months because I know that I'm going to be getting $10,000 later, and then I'll just take that $10,000 in a big chunk and pay it off. And so basically, and if you do it that way, like that's paying way over retail, right? I didn't amortize it over 5 years. I paid it off in 5 months. And so that's, I think, when you're really being an honest banker, you really throw it in there when you got it. And otherwise you want to be honest in the sense that you're paying it back at least retail, and you always want to make sure that you're not stealing the peas, as Nelson says, and just letting that ride for years out, which will then kill your business, kill your banking system.
Yeah, I'll add a couple things. I think it's really important to acknowledge that there's a reason the grocery store and the 4 words "don't steal the peas" is said so often and is included in one of Nelson's 5, primary principles, which, what are they? Number 1, think long term. Number 2, don't be afraid to capitalize. Number 3, don't steal the peas. Number 4, don't do business with banks. And number 5, rethink your thinking. So
Right.
I think all 5 of those principles can be captured in this grocery store example. We're talking about the long term. We're talking about not just thinking about the 1 year of startup costs and scouting out the location of a grocery store if you're thinking still in the grocery store term. But there's a reason I think this example is so powerful. And I also wanted to just say that, if you're just listening to this one episode and maybe IBC is totally new to you, yes, we are talking about real policy loans. That's how we access this cash value in our policies, and it does involve real, how Rob just described, wholesale or interest on these policy loans. But like he said, it's a lower interest than the retail if you were to go to Wells Fargo or whatever major bank out there, even smaller bank. But an example that I remember hearing from a mentor of ours is someone who didn't really know what they were doing with their policies. They had a policy when they were in their 20s, and they just borrowed, I think it was $3,500, and they took a policy loan out for $3,500, and nobody ever told them really about the interest charged on it, and that interest does compound if you don't pay it back over time. And 30 years later, she finally looked back at the status of that policy loan, and it had grown far, far beyond what she had expected or even understood was possible, because she thought it was essentially withdrawing, like you would a savings account. So that's where, the compound interest can, work against you if you're not practicing IBC as a responsible, honest banker, as we talk about a lot, and you're not stealing the peas, so that you don't run into surprises like that. And you can make your bank even more profitable, not to mention avoid pretty big, costly mistakes like that.
Yeah.
So let's talk about when the grocery store as a business fails. What causes the grocery store to fail, and also what will cause an infinite banking policy to fail?
Well, I think it was just what John was saying, is if you take out policy loans against your policy, if you take loans against the cash value or the face value of your policy, and you don't pay them back, they will compound interest. So you're borrowing the insurance company's money. The insurance company is charging you interest on it. And so if you just never pay those back, that will kill your system, because it's going to compound it. Like he said, we talked about earlier, leverage works both ways, right? Now leverage is working against you because the compounding is working against you because you're not being an honest banker and paying those off. So that will kill your business, your personal banking business, really quickly.
And I'm incentivized to pay above retail, far above retail, because if I were to do that, maybe for a mortgage, maybe for an auto loan, there's no benefit to that. I think, we can go through specific examples, but there is really no benefit to putting more into a loan like that than you have to. But for our policy loans, you have access to that money that you just paid back, and probably more, especially over time, as that is captured in your policy and continues to compound over time.
Mm-hmm.
Yeah, so just for the listeners, I want to paint a picture. If you were to take out that a policy loan, and that policy loan was allowed to accrue interest over time, like these guys have been talking about, eventually there's a strong possibility that the policy loan is growing faster than the premiums you're continuing to pay on an annual basis. And what happens when that occurs? You will see your cash value decrease rather than increase over time. You will see that you are now surrendering part of your death benefit. And that could certainly happen. And then at some point, where even if you were to pay your premium, the policy could lapse. What does that mean? It means you lose the coverage. You have no access to cash value any longer because it's dwindled because you've allowed interest to accrue, and you lose the death benefit coverage. So you could, at that point, theoretically, that person could be uninsurable and they would no longer qualify for life insurance. So that's how you kill the infinite banking concept, is by not being an honest banker, by stealing the P's, not paying the insurance company at least the wholesale rate. But as we've talked about, you should be charging more than that. And that's how this policy really kicks into high gear. And guys, Nelson switches the analogy a little bit here from going from the grocery store to a steam engine. And that's when the policy is in high gear that we're talking about here. He says, if you were to take a pot of water down to sea level and stick it over a fire and it went up to 210 degrees, he said, all you'd have is hot water. But what happens when we get to 212 degrees Fahrenheit? Now all of a sudden we've got steam. And as Nelson says, the steam engine was one of the greatest inventions, and the power that it was able to capture. When does this occur in the life of the infinite banking concept and the policy, and how does it differ for each person?
Yeah, like you're talking to Derek and John about the upfront costs of the grocery store. You know, you have to buy the land, you have to stock it, you have to hire employees. So that has costs. Starting a business has startup costs, and so that's the same with your policy. The front end has the costs are kind of all at the front end of the policy. And so it takes a while for you to then break even. Right around 6 or 7 is when it really gets over the hump. And now what you're putting in premium, you're getting more in cash value. And so that's when you start generating steam, because for every dollar you're putting in, you're getting more dollar back in cash value. And that's when it really starts to take off. And I think that's such a great analogy, because it's so true, right? Water just boiling at 210, it's still hot. It's boiling, but at just 2 degrees higher, it just becomes explosively powerful. And that's a really great analogy for how a life insurance policy works over time.
And that's not to say that you can't benefit from your policy during those startup years. You still do have access to cash value, and that's why we design our policies in a specific way, so that there still is some immediate access and benefits that you can gain from your policies. And lots of people absorb credit card debt, absorb auto loans, even within the first 2 weeks, when your cash value is available. So it's not just, I don't want any listener to think like, man, 7 years is the first time I'll be able to touch my policy. Right. By no means, I touched it, I think, within the first month, and benefiting from it, and seizing opportunities as they present themselves. So I think, with the grocery store, later on he talks about starting a bank. In those startup phases, honestly, there's not much access to the benefits of those businesses. But in our startup phases, you still do have a growing benefit over the years, over those first few years, to access your policy. And then again, I said the first principle, from Nelson is think long term. 6 or 7, maybe even 8 years, depending on how your policy and your age and your rating and everything, is just a blink of an eye compared to thinking long term, thinking 70, 100, 200 years if you want to, like to think about your family name and your family bank for generations to come. This is just totally a worthwhile cost to start it up.
Guys, one of the things that Nelson says towards the end of this section in the book, he says that the purpose of the grocery store business was to provide income for you that you could use as a source of retirement income. If you were to sell your business as you were approaching your retirement years, you would feasibly utilize the proceeds of that sale to help fund your retirement needs. Similarly, he's going to say that charging your captive customers, your family members, people in your own family banking system, charging them not only retail, but perhaps a point or two above retail, is going to provide you and your banking system with superior profitability. And he wants to paint the picture of you get the benefit of the growth in the policy during your retirement years. You could access this as a source of retirement income. Let's talk about why else would you want to charge your captive customers, your family members, a point or two above retail. Why would that make sense for them and make sense for you as the owner of the business?
Yeah, I think, the first question you would ask is, if I was going to take out a policy loan for one of my kids to get a vehicle, and they would say, well, then you'd give them less than retail, right? You'd give them wholesale. Well, then you're stealing the peas to begin with, right? Because that's going out the back door. So the minimum would be retail. But what he's suggesting there is charge more than retail. And then you might say, well, that's not very fair to your daughter, because you're making her pay more for her car than if she would have went down the street to a bank. But the key here is that paying over retail, that paying a premium over retail, is building her, my bank, which then will be passed down to her. So the idea there is that she's helped building her future bank by paying a little more now during this time. She'll reap the benefits down the road with the death benefit that will be passed down to her. So it's a win-win. She's helping fund her own future banking system. So it's very fair to do that. I would argue, because the benefits are going to be so great, down the road.
Yeah, I think it's important to mention that no dollar spent or invested, or in this case, paying back your policy loan, no dollar that's used for that purpose is actually ever lost. You're going to recover it, eventually. Like you talked about, Rob, the death benefit recovers many, many, many of those dollars that your family is going to benefit from tremendously. And it's not a sunk cost. It's not a interest payment to the bank that they get to profit on and build their skyscrapers and, pay their executives big bonuses. It's for your family, and it's not going to get lost, and it's going to stay in your system.
Yeah, guys, I think one of the key aspects to realize is by charging your family members above that retail rate, and just to provide some numbers, let's say interest rates right now are 8%. I'm going to charge family members maybe 10%. By doing that, I'm causing the younger generations or the current generation to be more conscious in their saving efforts. The interest, that additional 1 or 2% interest, is going to be utilized to purchase additional insurance. And by doing that, every year, the system is going to compound on itself. So as John was saying, it's not even a loss, but it's going to grow far greater than if it were to stay in a bank account or any other account, really. It's going to continue to swell and grow and compound over time. And what that then means for that generation, the younger generation, is that future tax-free death benefit as a source of windfall, just a large lump sum of cash at some point. And what a great way to bless your family, especially in the event of somebody's death, to say, look, I've got something else here that I want to bless family with when they need it the most. And it's tax-free. Who doesn't love tax-free death benefit?
So true. Good point.
And that dollar is doing multiple jobs. It's purchasing that car for your daughter in this example, and it's increasing your death benefit, and it's growing your cash value in parallel. I think to my time back in the Navy, with an undermanned ship, which I think is every ship probably in the Navy, if you ask me. There's no shortage of tasks and jobs, or they call them, collateral duties, essentially, for everyone to do. And I remember I was just like burned out. I think I had like 5 or 6 extra collateral duties to do on my ship.
Wow.
And it was exhausting. But your dollar does not get exhausted doing those multiple jobs. You put it to work and you place it in the right tool, it's gonna do those jobs for you. No sweat. It's gonna accomplish exactly what you tell it to, and exactly how you tell it to. And you're not gonna see it lose steam or get burned out like we do if we have multiple jobs. So just think of that dollar. It's not going to get tired for you. It's only going to do what you tell it. And if you tell it to do as many jobs as it can, it'll be even all the more effective.
I love that. Good analogy, John. Nice, a good story.
Well said. Guys, are there any other comments that you'd like to tell our listeners here before we wrap up this episode?
Nope, just love this section.
Yeah, this one gets me excited for the human problems part of this book.
Yeah.
He does have a nod to the temptation and just the temptation to steal at the back door, to charge yourself lower than wholesale rate if you want, and overcoming those human problems are very, very critical to having a successful family bank. And we'll get to that in the next parts, sections of this book. I'm looking forward to it.
Same here. And ladies and gentlemen, if there's anything about this episode that you have questions about and would like to learn more, feel free to reach out to us at thefamilybankingshow@gmail.com. And I would urge you to consider subscribing to the podcast here as we continue to bring out more and more content. As we've talked about, guys, before we started recording, we've got some exciting things to share with the listeners. In the next episode, we're going to be talking about the problem that Nelson saw with most Americans and their personal finances. And just to tee it up, guys, I just want to say it's actually worse now than when Nelson first wrote the book.
Thanks.
So I look forward to it, guys. And I hope to see you in the next episode.
All right. Thanks, John. Thanks, Eric.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.